As individuals approach retirement, they start looking for ways to cut expenses because soon the paychecks are going to stop. They're going to be distributing money out of retirement accounts to live off of in retirement. So one of the common conversations we have with clients is, should you surrender your life insurance policy? Mortgages are paid off. Kids are through college. There is no debt. So what's the point of even having these policies anymore? So for certain retirees, the answer is yes, you should surrender those policies. But for other retirees, the answer may be no. Hello, everyone. I am Michael Ruger. I am the managing partner of Greenbush Financial Group, and today I'm going to be sharing with you a conversation that we have with our clients as they approach retirement regarding their life insurance policies. For many of our clients, there is no longer a need for life insurance anymore. Mortgages have been paid off. Kids are through college, and a lot of times we're counseling those clients to say, hey, you can go ahead and surrender that life insurance policy and save yourself the cost, or use the cash value of that policy towards stuff you're going to be doing in retirement. Or there's a whole other subset of clients that we counsel on to say, hey, no, you should really keep that life insurance policy in force because something that's particular to their personal financial situation. I'll start off by explaining the scenario where we recommend to clients that they surrender their life insurance policies as they are in retirement or approach retirement because those policies are no longer needed anymore, and we'd rather see those clients save themselves the expense and save that money that they're committing to the insurance policy on something else, whether it's travel, gift to the kids, whatever they want. So in these scenarios, I always remind clients the true purpose of life insurance to begin with. So at some point in your life, you needed life insurance because you had mortgages against the house, kids that had yet to be put through college, you had debt or something else, that if something happened to one of the income of one of the spouses, you needed that life insurance policy to pay out so that surviving spouse or your dependents did not have some type of financial hardship because your income stream was essentially gone. But as individuals approach retirement, very frequently, there is no mortgage or the mortgage is very low. Kids are out of the house. All those financial liabilities have been taken care of. And you've amassed enough wealth now that if something were to happen to one of the spouses, there's enough assets sitting there that essentially you're self-insured, that those assets will take care of your spouse or dependents for the rest of their lives without the need of having to pay into an insurance policy. I'll explain this in a scenario. So let's say we're counseling clients that are both age 67 who want to retire next year, and they've accumulated $800,000 in their 401k accounts. And we show them via their return projections that based on their estimated expenses of retirement, that $800,000 plus their Social Security benefits is more than enough to sustain their expenses until age 95. So then the question becomes, why are they paying $2,000 or $3,000 per year into these life insurance policies? And our answer is, they really shouldn't be. At that point, they can surrender their life insurance policies, and then they can use that $2,000 or $3,000 they were spending on life insurance premiums on something else. This is even true for clients that have what's called paid up insurance policies, because some clients are like, hey, I've got these permanent insurance policies. I'm not even making premium payments, but they have big cash value in them. Should I surrender those policies? Sometimes still the answer is yes, because it's still an insurance contract. You are still paying for that insurance coverage every single year that you really don't need. So we then have to weigh the pros and cons of, hey, surrendering this policy and taking the cash value out and putting in something that's going to grow by more, or continuing to keep it in that insurance policy where mortality expenses and other expenses could eat up some of the appreciation. If I had to guess, I would say more than 60% of our clients fall into that camp that at some point they're surrendering these life insurance policies to do something else with them. Commonly, it is around these retirement years, but there's definitely a subset of clients that we meet with, and because of what's going on in their personal financial situation, we may actually recommend that they keep those policies in force for another X number of years or potentially for the rest of their lives, and that's what I'm going to go over with you now. So the scenarios we're going to be covering now are when we're counseling clients to say, hey, you should probably keep this life insurance policy in force for at least a set number of years into retirement or indefinitely for the rest of your life. And one of the most common scenarios we run into is someone enters retirement and they still have a sizable mortgage, they have HELOC, they have debt, and their assets are not enough to satisfy that debt obligation should one of the spouses pass away unexpectedly. We could lose a Social Security benefit. We could lose part of a pension. They might be doing some type of part-time retirement income that we would lose if one of the spouses passes away. So keeping that life insurance policy in force until that debt obligation has been satisfied may be a prudent decision. Scenario number 2 are individuals that are married that have pensions that instead of electing a survivor benefit with their pension, elected a single life, which means when they pass away, their pension benefit stops. And if it's a sizable pension, and that represents a big portion of the household income, since you didn't elect a survivor benefit, you may need a life insurance policy that if that spouse with a pension passes away and the pension stops, the surviving spouse may need a lump sum of money to sustain their standard of living for the rest of their life. Scenario number 3, where we're advising clients to hold on to their life insurance policies, are really the wealthier clients that could have an estate tax liability issue. So the estate tax limits are now very high. As I make this video today, for individuals, it's $13 million at the federal level. So that's $26 million combined for a married couple. But states have different estate tax limits too. Like I think in New York, it's like $6 million per person. So still they're very high. Most people right now do not have estate tax liabilities. But for those that do, some of them will say, hey, I'm going to have this permanent life insurance policy in place that because I'm going to have an estate that's over these estate tax limitations, my estate is going to have a tax liability. And that life insurance policy, I'm going to go put it in what's called an ILIT, an irrevocable life insurance trust, that essentially removes that life insurance policy from the estate, but it's able to pay the estate tax liability when that individual passes away. Scenario number 4 is some individuals just want to have a life insurance policy earmarked for inheritance for their kids or heirs. They say, hey, I know I don't really need this policy, but it's a permanent policy that I have to pay, let's say, $4,000 a year per year into. I'm comfortable doing that, knowing that when I pass, this might pay out, let's say, $500,000 tax-free to my beneficiary, and I always want to reserve that inheritance for my kids. Scenario number 5 of individuals that sometimes we counsel to keep their insurance policies is someone that has, let's say, an illiquid asset in their estate, something like a family business. So if, let's say, mom or dad own a privately held family business and they were to pass away, and that's the main asset, they might need another asset outside of that family business or liquid asset to essentially pay for probating the estate because it's a little bit more complicated. Attorneys, accountants, if there's an estate tax liability associated with passing those assets on to the next generation. So that life insurance policy may exist for the sole purpose of freeing up cash to pass in those more illiquid assets to the beneficiaries. Also in this category could be investment real estate. The 6th reason is also a more common reason that we would run into to counsel clients to say, maybe you should keep this insurance policy for at least a little bit longer, and definitely is poor health condition. Unfortunately, sometimes a health event will force individuals into retirement and they have these life insurance policies. And even for individuals that may not need them anymore, let's say a health event happens when someone's 67 and they have more than enough assets, even if they pass away without the life insurance policy, it might be, well, you have a really shortened life expectancy. So it might be prudent to continue to pay that $2,000, $3,000 per year, knowing that at some point, maybe in a not too distant future, this $300,000 or $400,000 life insurance policy could pay out to your beneficiaries. As you can see, this decision does vary individual by individual. While most of our clients do fall into that whole, I'm self-insured and I don't need these life insurance policies anymore, and I might as well save the expense of the premiums or use the cash value in the assets for something else in retirement. There's definitely a subset of clients in the scenarios that we just went through where our advice is you should probably keep this insurance policy at least for the next few years or indefinitely, depending on their financial situation. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.